Hello, my name is Matias Herrero. I hope you're staying safe during this COVID-19 crisis. I wanted to make this video to talk about a topic that is interesting to me and I hope it's interesting to you, which is the 5% discount rate that is used in base case scenario calculations of net present value of mineral projects. This is very common in the mining industry, in pre-feasibility, feasibility studies, as well as preliminary economic assessments. This 5% discount rate is often criticized by the industry as being low, and that's something that I wanted to explore with this video. I hope you like it. The discount rate is the minimum expected return that an investor would like to receive to invest in a particular asset. There's two elements to it. There's the time value of money and the risk profile of the asset. It is very difficult to quantify the risk of an asset. So what we do instead is we look at the cost of capital of the investor. For example, in the gold mining industry, gold producers will acquire a gold project that has a similar risk profile as the risk of the portfolio of assets of that gold producer. So we look at the cost of capital of that gold producer, which is easily determinable and which derives from or is highly correlated to the risk of the portfolio of that gold producer. And we use that cost of capital as our discount rate. To calculate the cost of capital of an investor, in this case a gold producer, we will start first with the equity cost of capital, and for that we will use the capital asset pricing model. The beta of large cap gold producers can be obtained from Yahoo Finance, and it's 0.15. This is the average for the large cap. Very low, as you can see. Some of them even have negative betas, as you can see on the table. The risk-free interest rate is 2.3%. I got that rate by looking at the 10-year government bond for the last 10 years. I like to use a 10-year bond and look back 10 years because that's the typical life of mine that is used in feasibility, pre-feasibility, and PEAs. The market rate, I use the Standard & Poor's 500 index. The return for the last 10 years, it's about 11.2% per year. If you look at the index since inception in 1926 till today, the average return is about 11.8%. So 11.2 is a reasonable rate. If you incorporate all these elements into the capital asset pricing model, you get an equity cost of capital for large cap gold producers of 3.62%. If we do the same for mid-cap gold producers, the beta for them, Yahoo Finance, again, is 0.73, and the resulting equity cost of capital for mid-cap gold producers is 8.84%. Now, if we combine both large caps and mid-cap gold producers, we have a beta of 0.5 and an equity cost of capital combined of 6.69%. Now let's look now at the debt cost of capital. For that, we need to look at the gold producer's balance sheet, see what their cost of borrowing is. Haven't done this for all of them, just only a few, and I can see that the cost of borrowing is pretty low. It has to do with the strength of the balance sheet, the incredible cash flow generation, great margins, and they're very low in betas. These companies are very attractive for investors because of their uncorrelated nature of these assets. Will be very attractive investment in any portfolio. So by looking at the cost of borrowing, I see that is about LIBOR plus 2 or 3%. So that will be a cost of borrowing rate of between 4 and 5%. Now, to come up with a weighted average cost of capital, we need to incorporate this cost of borrowing of 4 to 5% and the equity cost of capital for both large cap and mid caps that I mentioned before of 6.69%. You do a weighted average. In this case, we're going to do a simple average because we don't know what the ratio is for a gold producer to fund the acquisition of a project, but let's assume half and half. Then we get probably close to or reasonable to a 5% discount rate by using a 4 to 5% debt cost of capital and 6.69% equity cost of capital. So the conclusion I get with this is that a 5% discount rate used in discounted cash flow models in these studies to come up with a net present value of a gold project is therefore a reasonable rate. I hope you liked my video and thank you for listening.